Most investors dream about finding the next big stock that will skyrocket overnight. They chase the latest cryptocurrency, the hottest tech startup, or whatever is trending on financial news. But here's the truth that nobody wants to hear. The investors who get rich are usually the ones doing the most boring things imaginable. While everyone else is gambling on excitement, the real wealth is being built quietly in the background, one uneventful day at a time. The power of boring investments isn't just a theory. It's a mathematical certainty that has created more millionaires than any viral stock ever could. Why boring beats exciting? The human brain is wired for excitement. When someone hears about a stock that doubled in a week, or a cryptocurrency that turned a few $100s into millions, something lights up in their mind. It feels like opportunity. It feels like destiny. This is exactly why most people lose money in the markets. Research shows that retail investors spend an average of just 6 minutes researching a stock before buying it. They're not analyzing fundamentals or studying business models. They're reacting to emotions, following crowds, and chasing stories that sound too good to be true. This behavior has a name in psychology: recency bias. People assume that whatever happened recently will continue happening. If a stock went up last month, they believe it will keep going up. If everyone is talking about a particular investment, it must be good. This is how bubbles form. Investors pile into the same assets, driving prices higher and higher, until reality sets in and everything crashes. History repeats this pattern endlessly. The dot-com bubble of the late 90s saw investors throwing money at any company with a website, regardless of whether it had a viable business. Most of those companies went to zero. The same thing happened with housing in the mid-2000s, and more recently with meme stocks and certain digital currencies. The psychology of investing reveals a brutal truth: fear and greed drive most decisions. When markets are soaring, greed takes over and investors buy at the peak. When markets crash, fear kicks in and they sell at the bottom. This cycle of buying high and selling low is the opposite of what creates wealth, yet it's exactly what most people do. The exciting investments that grab headlines are the ones that trigger these emotional responses. They promise quick riches, but deliver quick losses instead. Meanwhile, the boring investments sit quietly in the background, doing what they've always done. They don't promise overnight success. They don't make headlines. They just compound steadily, year after year, turning patience into prosperity. The difference between exciting and boring investments isn't just about returns. It's about behavior. Exciting investments encourage bad behavior. They make people check prices constantly, trade frequently, and react emotionally. Boring investments encourage good behavior. They reward patience, consistency, and discipline. The hidden power of compounding. Compound interest has been called the eighth wonder of the world, and for good reason. It's the process where returns generate their own returns, creating exponential growth over time. Most people understand the concept in theory, but fail to grasp its actual power in practice. The math is simple, but the results are extraordinary. Take a basic example: investing $200 per month in a fund that tracks the 500 largest companies in the United States. Over the past 70 years, this type of investment has delivered average annual returns around 11%. That might not sound exciting compared to stories of stocks that double overnight. But here's what happens over time. Starting at age 25, that $200 per month grows to over $600,000 by age 65. That's not from brilliant stock picking or insider knowledge. It's just from showing up consistently and letting compound interest do its work. Increase that monthly investment to $300 and the total approaches $1 million. This is wealth built from discipline, not drama. The key word is time. Compound interest needs time to work its magic. The longer money stays invested, the more powerful the compounding effect becomes. This is why boring investments are so effective. They're designed to be held for decades, not days. Between 1950 and today, an investment tracking the 500 largest companies has never lost money over any 20-year period. There were plenty of scary moments along the way: market crashes, recessions, wars, pandemics. But investors who stayed invested through all of it ended up significantly wealthier. The ones who jumped in and out, trying to time the market or chase excitement, typically underperformed. Studies consistently show that passive investments, which just track market indexes, outperform the vast majority of actively managed funds. Between 2024 and 2025, only 33% of active funds beat their passive counterparts. The professionals, with all their research, analysis, and trading, couldn't beat the boring approach of simply owning everything and holding it. The reason is simple: active management comes with higher fees, more taxes from frequent trading, and decision-making driven by emotion and ego. Boring investments avoid all of these pitfalls. They have minimal fees, low turnover, and remove emotion from the equation. Dividends add another layer of power to boring investments. Companies that consistently pay and increase dividends have historically outperformed the broader market, especially during downturns. Between 1930 and 2021, dividends contributed roughly 40% of total returns from stocks. That's not a small detail. That's nearly half of all wealth creation coming from the most boring aspect of investing. These dividend-paying companies aren't the flashy startups that promise to change the world. They're the established businesses selling everyday products that people need regardless of economic conditions. Food companies, utilities, healthcare providers. Boring on the surface, powerful underneath. The magic happens when those dividends get reinvested. Instead of taking the cash, investors who reinvest dividends buy more shares, which generate more dividends, which buy even more shares. This creates a compounding loop that accelerates wealth creation over time. How to embrace boring investing? The strategy for boring investing is almost painfully simple. Find low-cost funds that track broad market indexes. Invest consistently regardless of market conditions. Reinvest all dividends, hold for decades. That's it. No complicated trading strategies, no market timing, no chasing hot tips. The hardest part isn't understanding the strategy. It's sticking with it when everything around you screams that you're missing out. When coworkers brag about their latest investment doubling, it takes discipline to keep doing the boring thing. When the financial media floods airwaves with stories of overnight millionaires, it takes strength to ignore the noise. When markets crash and fear takes over, it takes courage to keep investing. This is where most people fail. Not because the strategy is wrong, but because they lack the temperament to follow it. The tools are available to everyone. Index funds tracking major markets have expense ratios below 0.1%. That means for every $10,000 invested, the annual fee is less than $10. Compare that to actively managed funds that can charge 10 to 20 times more, and the advantage becomes clear. The devil is in the details of consistency. Investing the same amount every month in good markets and bad removes the temptation to time things perfectly. It's called dollar cost averaging, and it works because it forces investors to buy more shares when prices are low and fewer shares when prices are high. The psychological benefit is equally important. Having a system removes the stress of decision-making. There's no agonizing over whether now is the right time to invest. The system says invest, so you invest. Diversification makes boring investing even more powerful. Instead of betting everything on one country or one sector, spreading investments across different markets reduces risk without sacrificing returns. Funds exist that cover international stocks, bonds, real estate, and commodities. Building a portfolio from boring index funds across these categories creates a robust foundation for long-term wealth. The boring approach also has tax advantages. Because there's minimal trading, there are fewer taxable events. Money that would have gone to taxes instead stays invested, compounding over time. This might seem like a small detail, but over decades it adds up to tens or even hundreds of thousands of dollars. Perhaps the biggest challenge is mental. Boring investing requires accepting that you won't have exciting stories to tell. There's no drama, no edge of your seat moments, no brilliant moves that make you feel like a genius. There's just steady, predictable progress toward financial independence. For some people, that's disappointing. They want investing to feel like a game they can win through skill and cleverness. But for those who understand that wealth comes from patience, not performance, boring becomes beautiful. The math doesn't lie. The history doesn't lie. Boring investments have created more wealth for more people over more time than any other approach. They work for the simple reason that they align with how markets actually function over long periods. Markets go up more than they go down. Companies that generate profit tend to keep generating profit. Dividends compound. Time heals short-term volatility. These aren't exciting truths, but they're reliable ones. While the world chases the next big thing, the real fortunes are being built by people who figured out that boring is brilliant. They understood that excitement is expensive and patience is priceless. They learned that doing nothing is often the hardest and most profitable action of all. The power of boring investments isn't about avoiding risk. It's about avoiding stupid behavior. It's about harnessing the unstoppable force of compound interest and giving it enough time to transform modest contributions into substantial wealth.